In this video we are going to talk about dividend stocks with a high yield. So before starting this video, please like this video and subscribe to this channel for our future updates. The purchase of stocks that pay a high dividend yield can prove to be a sensible investment. Those who own shares in dividend-paying corporations receive an annual payout from the company equal to a percentage of the firm's earnings. High-yield dividend stocks are one of the most common sources of income for investors who are looking to generate income from their investments. They are, nonetheless, particularly important during difficult times such as the present. Number 1. Pfizer. Pfizer, PFE, $43.96, is one of the world's largest pharmaceutical firms in terms of revenue, with annual revenues over $40 billion. Pfizer, PFE, $43.96, is a leading pharmaceutical company in terms of revenue. According to the company's website, it used to supply a wide range of healthcare items and chemicals, but prescription drugs and vaccines now account for the vast bulk of its revenues. Its portfolio includes 8 blockbuster products, including the cancer therapy Ibrance, the cardiovascular treatment Eliquis, and the immunology therapeutic Xeljanz. PFE is also a leading provider of specialty pharmaceuticals. A strong pipeline of items under development is also available from PFE. As a result of its joint venture with GlaxoSmithKline, GSK, and the merger of its Upjohn unit with Mylan, PFE has seen its size decreased. The company now has a more diverse portfolio of drugs and vaccines that are cutting edge in their field. It is expected that sales growth will be able to accelerate as a result. According to the business, sales of important drugs such as Ibrance, Inlyta, and Eliquis are likely to grow at a significant rate in the coming years. Aside from that, the company's COVID-19 vaccine has established itself as a key contributor to its bottom line. A solid pipeline of products, including a number of late-stage products that have the potential to fuel future growth, is also available at PFE. Recent approval of Vyndaqel, a cardiovascular drug, by the company has the potential to be a game changer in the field of rare diseases, according to the company. The company presently offers a very appealing dividend yield of 3.6%, which is a respectable return on investment. Furthermore, PFE is the only one of the high-yield dividend businesses listed on this page to have achieved an overall grade of A, although the others have received grades ranging from B to C. According to the approach used by PAR Ratings, this results in a strong buy rating. Pfizer has been assigned a growth rating based on the company's potential for expansion. The upcoming quarter is expected to see revenues rise 62.7% year-on-year and earnings rise 36.1%, according to analysts. The projections predict that profits would climb by 67% and sales will increase by 74% over the prior year. Number 2. Walgreens Boots Alliance. Founded by the merger of Walgreens and Alliance Boots, Walgreens Boots Alliance, WBA, $46.73, presently operates more than 21,000 stores in 50 states and 11 countries worldwide. The company also owns the world's largest pharmaceutical wholesaler and distribution network, with more than 390 distribution centers that annually distribute to more than 230,000 pharmacies, doctors' offices, healthcare facilities, and hospitals. WBA has launched Boots Online Doctor, a new service that connects physicians and patients online, as part of the Health Hub initiative. Aside from that, the company is accelerating the deployment of its full-service primary care clinics in conjunction with VillageMD, making WBA the only national drugstore to offer physician-led primary care clinics. Walgreens has a 4.1% return on investment. When it comes to high-yield dividend stocks, this is a great deal of money. WBA has a value grade of B, which indicates that the company is cheap based on a variety of valuation indicators. For example, its trailing price-to-earnings P/E ratio is 18.1 and its forward price-to-earnings P/E ratio is 9.4. As for stability, Walgreens scored an A, which indicates that the company has proven continuous growth and price performance. Number 3. Gilead Sciences. Gilead Sciences, Gild, $68.35, is a pharmaceutical business that discovers and commercializes therapies for infectious diseases that are life-threatening to humans. In addition to HIV/AIDS, the firm also specializes in hepatitis B and C treatment. While Gilead is best recognized for its HIV drugs, the company also researches and produces treatments for liver and blood disorders, cancer, inflammation, and respiratory diseases. After receiving complete approval from the Food and Drug Administration (FDA) in October to utilize Veklury, remdesivir, to treat COVID-19 patients, the business began marketing the drug. Gilead's sales of the medication totaled $2.8 billion in the previous fiscal year. Furthermore, Gilead's HIV and hepatitis C portfolios have the potential to generate significant profit margins due to the fact that these therapies require a small sales staff and low-cost production. There are a number of single-tablet HIV medicines available from the manufacturer. Its next-generation HIV medications, Genvoya and Biktarvy, are also aiding the company's efforts to expand its market share. The corporation is expanding its medicine portfolio beyond HIV and hepatitis C by acquiring other pharmaceutical companies. In reality, it is focusing on oncology since Trodelvy, a medicine used to treat breast cancer and urothelial cancer, has a lot of potential for indication expansion. Number 4. Abbvie. Abbvie AB, $115.45, is a pharmaceutical company that has a major focus on immunology and oncology research and development. Humira, the company's most profitable drug, accounts for around 37% of total Abbvie revenues. In May 2020, Abbvie acquired Botox manufacturer Allergan, which shifted the company's portfolio away from reliance on Humira, its flagship pharmaceutical, and toward other products. As a result of the business's blockbuster cancer therapy Imbruvica, as well as its immunology treatments Skyrizi and Rinvoq, the company is well positioned for long-term growth. At this point, the two immunology drugs are performing substantially better than anticipated. Abbvie has expanded the labeling for Imbruvica and another cancer medication, Venclexta, which are both currently on the market. In addition, the company has a strong late-stage pipeline that includes a number of compounds with potential to be blockbuster drugs. While Humira is no longer an income generator, it was previously. Currently, the medication is approved in the United States for 10 different purposes, and sales have been steadily increasing as a result of strong demand patterns. For the medicine, the dermatological and gastrointestinal categories are experiencing particularly strong local growth. Aside from the fact that it is a member of the Dividend aristocrats, Abbvie also has a good yield of 4.5%. According to the PAR rating system, it receives an overall grade of B, which corresponds to a buy recommendation. The company has a B value grade, which is comprehensible given the stock's anticipated P/E ratio of 9.2 and its low projected P/E ratio. In addition, the price-to-sales ratio of Abbvie is lower than the industry average, with a ratio of 3.8. Number 5. GlaxoSmithKline. GlaxoSmithKline, GSK, $40.24, is a pharmaceutical company that ranks among the top 10 largest in terms of total sales. Respiratory, cancer, and antiviral medicines, as well as vaccines and consumer healthcare products, are among the therapeutic areas in which the company is well established. As a result, Gilead has utilized joint ventures to achieve larger scale in a number of sectors, including HIV and consumer products. As a result of the introduction of new and specialty products, such as Nucala, Trelegy Ellipta, Shingrix, and Juluca, GSK has been able to make up for a decline in sales of established pharmaceuticals as a result of the introduction of generics. Several additional drug extension approvals are likely this year, demonstrating that the company has made remarkable success in developing its pipeline of medications. This should aid in the growth of revenues. Furthermore, the company's presence in a variety of geographical areas may benefit its bottom line. Additional growth potential should be realized through expansion into other markets such as Japan, for example. By acquiring product portfolios from businesses such as Bristol-Myers Squibb, GlaxoSmithKline has also made inroads into new markets, BMY. The company received an A in the component of the evaluation that measured value. Price-to-earnings ratio is 14.3, which is less than 15, and the price-to-sales ratio is 2.2, which is a low value. A stability grade of B is also assigned to GSK, indicating that the company has demonstrated a track record of stable growth and price performance over time. Consequently, its beta is only 0.54, which indicates that it experiences almost half the level of volatility experienced by the broader market. When measured on a percentage basis, GSK is the highest-yielding dividend firm among the high-yield dividend businesses profiled here, with a yield of 5.4%. According to the Power Ratings system, it has an overall grade of B. This translates to a buy recommendation on the stock market. What do you think of our video? Let me know in the comments section below. If you enjoyed this video and want to hear from me again, be sure to hit that subscribe button before you go.